Hello, my name is Nicole, and this video is about the synthetic straddle. Is now a good time to consider this strategy? As we move through 2025, traders are divided about where the market is heading. The combination of technological disruption, policy uncertainty, geopolitical risk, and structural market changes are creating an environment where even experienced traders and investors are finding their usual playbooks less reliable. This uncertainty creates an environment for strategies that can capitalize on market movement rather than direction. That's the fundamental idea behind volatility-based strategies like the one we're discussing today. Intellectually honest traders will admit that they have no idea what the market is going to do for the rest of 2025 and beyond. Our challenge, therefore, is to figure out how to structure a position with a reasonable risk profile and a high probability of success regardless of market direction. That's where the synthetic straddle comes in. But before we talk about the synthetic straddle, let's review what the long straddle is. A long straddle involves buying both a call option and a put option at the same strike price for the same expiration date. Since calls are bullish and puts are bearish, combining them creates a position that's theoretically directionally neutral, but benefits from large price swings in either direction. The Greek profile of a long straddle includes delta neutrality at initiation, positive gamma, negative theta, and positive vega. So what are the main drawbacks of a long straddle? Well, you're paying premium for both the call and put options, making it expensive and very vulnerable to decreases in implied volatility as well as time decay. The underlying needs to make a significant move before expiration to overcome the cost of both options. What if there was a way to create a similar risk profile with potentially better characteristics? The synthetic straddle or reverse hedge creates a similar risk profile to a traditional straddle, but with a different structure. Instead of buying both calls and puts, you first buy call options on more shares than you plan to hedge, and next sell short stock or futures to offset the delta of your call options. This creates a position that starts out as delta neutral but has positive gamma, meaning it benefits from price movement in either direction. So let's talk about why this strategy has an edge. The synthetic straddle exploits market inefficiencies and offers flexibility. First, it has a negative skew advantage. Call options typically have lower implied volatility relative to put options due to negative skew. We're buying the cheaper calls and avoiding the expensive puts. During times when many market participants are complacent, implied volatility is relatively low, and many times call options are underpriced relative to realized upside volatility. And finally, there's a flexibility advantage. Using short stock gives a trader more flexibility to adjust delta exposure as markets move. What follows is a demonstration that I made on March 11th of 2025 at a time when I was introducing this particular strategy as a way to play markets going forward. Let's take a look at what I talked about. Okay, so now that we are in the trading platform, let's walk through a specific example to see how this works in practice. Say I believe SPY is going to be volatile in the coming months, but I don't know which direction it's going to move. I also believe that longer dated call options in this underlying are currently underpriced relative to what I expect realized volatility to be for those options. Here's how I might structure a synthetic straddle. So the assumption is that the call options are underpriced, and we're going to assume that I believe they're underpriced in the July 18th, 2025 expiration cycle, where there's 128 days left until expiration. I'm going to scroll down until I get to the call options that I feel are underpriced. And for this example, I'm going to assume that the 600 strike call options are underpriced. I'm interested in buying those as a result. So I'm going to click on the ask here. And in this example, I'm interested in buying 10 of these. Okay, so we know that buying 10 of these, where they're priced at $8.28, would cost me roughly $8,280. And you can see the price there is moving around because this is a live example. Okay, so I'm going to buy 10 call options for $8.26, and that's going to cost me a little over $8,000. I'm going to open up price slices here And move this up so that it's easier to see. And this box is going to tell us how those call options are going to perform based on how SPY might move. And this is set in 3% increments, okay? So if the SPY were to go up by 3%, the value of those call options will appreciate by approximately $6,300. Conversely, if the SPY were to go down 3%, the value of the position would go down by $3,200. Now let's take a look here at the zero line to see what this position's Greeks would be. So the call options give me a positive delta of 284, a positive gamma of 6.29, a negative theta of negative 80, and a vega of 1123. The second step of setting up this trade is to neutralize delta. So I am going to short 272 shares of SPY to get that delta as close to zero as I can. So 272, and there, actually, maybe I do 282. There we go. There, we can see that the delta is very close to zero. So that's a neutralized delta. We still maintain our positive gamma. We still have negative theta, and we still have positive vega. Let's see how this trade will perform, or this structure will perform under different price movements in SPY. So we can see here that the further away SPY trades from its current value, the more money the trade structure will make. So just like a straddle, okay? And one thing I want to note here while we're in the trading software is notice how your delta changes as price changes with SPY. So as SPY moves up in value, the profit of the structure is going to move up and your delta actually gets bigger. As SPY moves down in value, the profit of your structure also moves up, but the delta gets more negative in value. Okay, so very characteristic of a traditional straddle. Okay, and I want to talk about how we might manage this position regarding these changes in delta as SPY moves around. Okay, so now I want to talk about managing the synthetic straddle, and I'm going to incorporate that previous example into a review demonstrating how this position could have been managed throughout the course of the last few months. The real power of this strategy comes from how you manage it over time. If the underlying stock or futures position begins to rise, your short stock or futures position will lose money, but your calls will gain value at an accelerated rate thanks to positive gamma. In this scenario, you might choose to short additional shares to maintain delta neutrality, take partial profits on some call contracts, or allow your position to become directionally biased if your market view changes. If the underlying stock or futures position begins to fall, your short stock or futures position will make money, while your calls will lose value at a decelerating rate thanks to positive gamma. In this scenario, you might choose to cover some of your short shares to maintain your desired exposure, roll your calls down to a lower strike price, or add to your call position at lower prices if you believe the market will eventually rebound. So let's look at the Think Back tab in the Thinkorswim trading platform and go back to March 11, 2025, and I'm going to populate the position that we just reviewed. So we're long 10 July 18th, 2025, 600 call contracts and short 282 shares of SPY. And you can see on a chart here what was going on March 11, 2025, and what happened afterwards. So you can see that the market did indeed have a lot of volatility following the placement of that trade. So we're going to use the Think Back functionality here in the trading platform to see how that trade would have performed throughout the course of time. And what I'm going to do here is I'm just going to go through and fast forward to every Friday through March just to see how that position would have fared. And we can see the position is down as a whole on March 28th. And let's go to the chart and see what that looked like. You can see here we had some selling. The calls lost value, but also the short shares were also in the negative. I'm going to head back to the Analyze tab here. You can see that that position was down almost $3,000. Now let's head into early April, and we can see things had turned around. As you remember, the market had started to sell off. And as we move through that first full week of April, we can see this position really benefited from the dramatic selling and increase in implied volatility that we saw in the markets. And by April 9th, 2025, the short shares were up by $18,076, while the long calls were down by $7,000. And let's just take a look at what those calls would have been worth in that July 18th, 2025 expiry. And the 600 calls were now trading somewhere between $1.42 and $1.51. So that position would have been worth about $1,400. Now let's say that I wanted to lock in gains on those shares and just leave the calls on, just to see if the market could bounce back at that time, and I'd be willing to give up almost $1,400 for the optionality to leave those call options on, which I'd feel good about because I made $18,000 on the short shares. So I'm playing offense here. And in the software, I just went ahead and mimicked closing out that position by showing that I purchased 282 shares. And let's just move through time here to see what the overall position would have done throughout May and June. And again, I'm just going through weekly, every Friday. I'm just checking in on the position to see what it would be doing. And the position is up nicely. And now those calls are gaining value because, as we know, the market rebounded sharply. And we are now trading at all-time highs as of late June. And we're going to go to today, which is Friday, June 25th, 2025. And this is what the position would have looked like if I would have just kept that on and made those adjustments. So let's calculate what the overall profit on the position with the adjustment would have looked like. So right here, we're just confirming the profit that we made on the short shares, which is $18,000, and we're adding the $5,775 profit from the long calls that we kept on, and the position would have been profitable by $23,879. And this just demonstrates simply covering your shares in the middle of selling and leaving the long calls on to benefit in the event of a V-shaped bounce, which is what we experienced. Not a bad trade. Advanced traders can also consider selling out of the money put premium against their short stock or futures position, which can include selling outright married puts or put spreads. This can help to offset the negative theta from the long calls, essentially creating a position with limited risk, positive gamma, reduced or even positive theta, and exposure to implied volatility changes. Before implementing this strategy, consider these practical aspects. Capital requirements. This strategy requires sufficient margin for the short position, so ensure that your account is properly funded. Many traders like to use futures for the capital efficiency that they afford. Next, market selection. While we used SPY as an example, this strategy works best on underlyings with liquid options markets and reasonable borrowing costs for short positions. Next, implied volatility. The strategy works best when call options are reasonably priced relative to expected future volatility. Look for situations where you believe realized volatility, whether it be to the upside or downside, will exceed implied volatility. Now let's talk about position sizing. Start small until you're comfortable with the mechanics. Remember that while the risk is defined, losses can still occur if the market doesn't move sufficiently before expiration. And finally, tax considerations. Using futures instead of stock can provide a 60-40 long-term short-term capital gains treatment under Section 1256, potentially lowering your tax burden compared to short-term gains on stock positions. As always, consult a tax professional if you have any questions or concerns regarding this. If you found this video helpful, please like, share, and subscribe. Thanks for listening. Drop some comments below and be awesome.